Chapter 3 Problem Solver, Job Order Costing Journal Entries. Hello all. Students frequently have difficulty with journal entries, so I've developed this video in hopes of building your confidence. This problem is designed to review debits and credits using T-accounts for a job order costing system. PG Corporation uses a job order costing system because it produces products which are unique to its customer base. The problem information includes data related to the beginning balances for cash and the raw materials, work in process, and finished goods inventories. It also includes 11 transactions that need to be recorded. Problems like this will always give you beginning balances for the permanent accounts as they have right here. If the balances are not presented in this type of format, you'll probably be given a previous period's balance sheet with all the balances listed. So before we start posting transactions to the T accounts, let's get the beginning balances in place. We start off with cash, put in a BB for beginning balance, and enter $120,000. Drop down to raw materials, enter BB, and $15,000. Drop down to work in process, enter BB, and $80,000. And then drop down to finished goods, enter BB, and its balance of $20,000. You should note that to enter the beginning balances, I used a point and collect technique to save time and assure accuracy. I'll use the point and click technique throughout this problem. For point and click techniques, you type the equal sign, point to the cell with the amount that you want to enter, and click enter. At this point, we have all the beginning balances in our T accounts. When you studied financial accounting, you learned that once financial transactions occur, they get journalized and then posted to the ledger. We can use T accounts to track those transactions, and that's what we're going to do for this problem. So instead of using journals and then posting to the ledger, we're just going to put all the results in the T accounts. Now remember, with a T account, the left side is the debit and the right side is the credit. So regardless of what type of account it is, the left side is debit and the right side is credit. Debit is left, credit is right. Assets increase on the debit side and decrease on the credit side, while liabilities and owner's equity increase on the credit side and decrease on the debit side. Assets, liabilities, and owner's equity accounts are permanent accounts and will always have carrying balances from one accounting period to the next. The permanent accounts show up on the balance sheet. Revenues and expenses, on the other hand, are temporary accounts because they are closed out to retain earnings at the end of each accounting period so that they can start fresh for the new period with a zero balance. Revenues will increase on the credit side while expenses increase on the debit side. Knowing the increase and decrease sides for these accounting elements is key to processing transactions correctly. Every time you read a transaction, you are going to say to yourself, what accounts are involved? How are they classified? In other words, are they assets, liabilities, owner's equity, revenues, or expenses? Once you know how they're classified, you're going to ask yourself, are they increasing or decreasing? Answering those questions will tell you what you should debit and what you should credit. Remember that for every transaction you do, debits have to equal credits. Let's look at the transactions now. Transaction 1 states that raw materials were purchased on account. We have two accounts involved, raw materials and accounts payable. The wording on account tells you that because we are paying later, we need to use accounts payable, which is a liability. If we were paying cash for the raw materials, the transaction would read raw materials purchased for cash. Raw materials are an asset. Because I'm purchasing raw materials, the account is increasing. Anytime an asset increases, we debit it. So I'm going to go over to raw materials, enter the transaction number 1, and debit the account for $100,000 using a point and click. Next, I'll move over to accounts payable. Again, accounts payable is a liability. It is increasing as well because we now owe somebody $100,000. I'm going to enter transaction 1 and credit the account for $100,000, again with a point and click. Let's look at transaction 2. Direct materials are requisitioned for use in production totaling $70,000. The two accounts involved in this transaction are work in process and raw materials. So we have two assets involved. The work in process account is increasing, while the raw materials account is decreasing. Always take care of the debit entry first. Enter transaction 2 next to work in process, and then debit the account for $70,000 because we are starting to manufacture our product. Move to raw materials. Raw materials is going to decrease, so I'm going to credit it for $70,000. Why? Because we are using raw materials to start the production process. Transaction 3. Indirect materials are requisitioned for use in production totaling $20,000. Whenever indirect materials are used, we debit manufacturing overhead. So let's enter transaction 3 and debit manufacturing overhead for $20,000. Remember, indirect materials are small items like glue, screws, or any material used in the factory during the production process that can't be traced directly to the product. So when this happens, the actual amount of indirect materials used is going to be entered into the manufacturing overhead account on the debit side. At the same time, we're going to credit raw materials to show that $20,000 has come out of the raw materials inventory account. So you notice the raw materials inventory account includes both direct materials and indirect materials. To the extent that direct materials are used during the production, they get debited to work in process. To the extent that indirect materials are used, they get debited to manufacturing overhead. Transaction 4 says that direct labor wages were incurred totaling $130,000. The two accounts involved in this transaction are work in process and wages payable. The reason why work in process is involved is that because direct material and direct labor incurred will always get debited to work in process account. The work in process account is used to keep track of cost until the product is completed. Once the product is completed, we move it out of work in process and into the finished goods inventory. So for this transaction, enter number 4 first, and then debit work in process for $130,000. Now go over to wages payable, enter number 4, and credit it for $130,000. Debits equal credits. Look at transaction number 5. It's similar to number 4, but says this time that indirect labor wages incurred were $15,000. For actual amounts of indirect labor, we use the manufacturing overhead account to record the debit. So put number 5 in for the transaction, point to the cell with $15,000 in it, and click enter to record the debit to manufacturing overhead. Next, go up to wages payable and enter the credit of $15,000 with a point and click. Transaction 6 says depreciation was recorded on factory equipment for $10,000. From financial accounting, you learn to record depreciation with a debit to depreciation expense and a credit to accumulated depreciation. When you look at the T-accounts, you notice that there is no depreciation expense account. The reason that there is no account for depreciation expense is that this transaction involves factory equipment. When depreciation is being recorded on factory equipment, that is an indirect cost of production. All indirect costs of production, whether they are indirect material, indirect labor, or cost of factory operations like utilities and depreciation, will get recorded in the manufacturing overhead account with a debit entry. So we are going to the debit side of manufacturing overhead, put a 6 in there for the transaction number, and point to the $10,000. Now the credit is going to be accounted for in the accumulated depreciation account, just like it would always be. So we go to the credit side of accumulated depreciation, put a 6 as the transaction number, and point to the $10,000 of depreciation. Debits equal credits. So whenever we have depreciation on factory equipment or factory buildings, we're always going to debit manufacturing overhead and credit accumulated depreciation, because depreciation on anything used in the production process is an indirect product cost. Had the problem said there was depreciation to be recorded on the office building or office equipment, then we would have treated the transaction as a period cost and debited depreciation expense and credited accumulated depreciation. Again, any time that you see the word factory as part of the transaction description, it means that either work in process or manufacturing overhead will be used as one part of the entry. Let's look at transaction 7. We have additional manufacturing overhead costs incurred and due of $110,000. So again, we're talking about manufacturing overhead, and because it is incurred and due, we are also talking about accounts payable. So we will come down here to the debit side of manufacturing overhead and enter transaction number 7 and then $110,000. Then we're going over to accounts payable, entering transaction number 7 there and crediting the account for $110,000 because accounts payable is a liability which is increasing. Again, debits equal credits. Now let's talk about transaction number 8. Transaction 8 says manufacturing overhead costs applied to jobs is $165,000. So manufacturing overhead is applied to jobs using the predetermined overhead rate that we've studied. We are applying $165,000 of overhead to our jobs. The accounts involved here are work in process and manufacturing overhead. What we're going to do here is go to the debit side of work in process, enter transaction number 8, and debit the account for $165,000. Next, we are going over to the credit side of manufacturing overhead, entering number 8, and the $165,000 of overhead applied. So we debited work in process for $165,000 and we credited manufacturing overhead for $165,000. Let's talk about the manufacturing overhead account. It is important that you realize that the manufacturing overhead account is a clearing account. As a clearing account, we will zero it out at the end of the accounting period. Because it is a clearing account, it will never show up on the financial statements because its balance will be zero at the end of the period. On the debit side of the manufacturing overhead account, we will record all the actual indirect costs incurred during the production period. So any actual indirect costs get debited to manufacturing overhead as they are incurred. On the credit side, we enter the estimated overhead based on the predetermined overhead rate that we're going to apply to our jobs throughout the accounting period. Transaction number 9 asks that we record the cost of jobs completed and transferred from work in process to finished goods inventory. So all along, we've been saying that the work in process account is used to track cost of production until the goods are finally finished. Once the goods are finished, we move those goods or transfer them out of work in process and record them in the finished goods inventory account. Transaction 9 is doing that. So for number 9, the two accounts involved are finished goods inventory and work in process. Both are assets, with finished goods increasing and work in process decreasing. For this transaction, we'll enter the number 9 and then debit finished goods inventory for $365,000. Then we will move to work in process and credit work in process for $365,000. Debits equal credits. So what have we done? We have taken the $365,000, which represents the cost of goods manufactured during the period, and we have transferred them out of work in process and into finished goods inventory where they're going to be held for sale. Transaction number 10 says that we are selling the goods for cash with a markup of 60% based on product cost. So some of the goods in the finished goods account are being sold at this time, and we have determined the selling price by marking up the cost by 60%. The goods transferred to finished goods inventory were $365,000, while the sales total was $584,000. Your calculation to get to $584,000 is to take the $365,000 and multiply it by 1.6 because it is always 1 plus the markup stated as a decimal. Multiply that and you get $584,000. So what we are going to do now is record the sale. For this transaction, the accounts involved are cash, which is an asset, sales, a revenue account, cost of goods sold, an expense account, and finished goods inventory, another asset account. Let's go to cash, enter transaction number 10, and debit cash for $584,000. Next, let's move to sales. Enter transaction number 10 and credit sales for $584,000. So debits equal credits for the sales portion of the transaction. The second part of the transaction requires that we show that the goods which were part of finished goods inventory are no longer there. To do this, we need to debit cost of goods sold and credit finished goods inventory. Let's do the credit to finished goods inventory first. We enter number 10 and credit the account for $365,000 to reduce its balance. The goods which were in finished goods inventory are no longer there. Where does the $365,000 go to? All along, we've been saying that when finished goods are finally sold, they become part of an expense known as cost of goods sold. So we move to cost of goods sold, enter number 10, and record the $365,000 with a debit to the account. The final transaction asks that we adjust for the variance due to the amount of manufacturing overhead applied. Okay, so let's look at the manufacturing overhead account and let's see if it is zeroed out. When we add the debit side, we get a total of $155,000 actually spent on manufacturing overhead during the period. Now I go over to the credit side where my total applied was $165,000. So at this time, I have a $10,000 credit balance. We need that balance to go away because this manufacturing overhead account needs to be zeroed out. Before we do anything, ask whether the balance represents over-applied overhead or under-applied overhead. Because we applied $165,000 of overhead during the period when we actually incurred $155,000 in costs, we have an over-applied overhead balance. We have too much overhead costs recorded for the period. If we have too much overhead costs, then our cost of goods sold is too high, our gross margin is too low, and our net operating income is too low. So what do we have to do at this point? We have to zero out the manufacturing overhead account. What am I going to do to zero out the account? Well, if I have a credit balance of $10,000, to close it out, I'm going to have to debit it for $10,000. That'll zero the account out. So for transaction number 11, I'm going to turn around and say, let's debit manufacturing overhead for $10,000. If I'm debiting manufacturing overhead for $10,000, I need to credit something. My choices are to credit cost of goods sold, or I could allocate the $10,000 between cost of goods sold, work in process, and finished goods inventory. To keep things simple, we will credit cost of goods sold. So we will move to the credit side of the cost of goods sold account, enter transaction 11, and record the $10,000 credit. Now what happens? What I have just done is corrected my books to reflect the costs which have actually been incurred during the period. What's my cost of goods sold for the period? Well, will it be reported on the income statement at? Not $365,000, but $355,000. The difference between the debit and the credit amounts recorded in the cost of goods sold account. That's it for these journal entries. The whole goal here is to help you understand how transactions are recorded and how they affect performance results. For every transaction, debits must equal credits. When you are looking at transactions, always determine what accounts are involved, always determine how they are classified. Once you determine how they are classified, determine whether they are increasing or decreasing. Once that is done, you will know which account gets debited and which account gets credited. That takes care of this problem. I hope this stuff makes a little more sense to you. With little practice and by following the thoughts presented on this slide, you should be able to do okay for yourself. Thank you for watching the video. Good luck.